On today's episode, we are going to take a look at Smile Direct Club, so let's get started. Alright guys, and tomorrow we're having a few more companies doing earnings. We have big companies like Wix, Norwegian, and NortonLifeLock, and today Sony did, and earlier this Monday Under Armour did an earnings report. So if you guys want me to take a look at any of those companies, make sure to post on the comments, or any other company that just reported earnings. CyberArk, Logitech, there are also some good ones that reported this past week. So let me know in the comments, guys. Post in the comments, and like always guys, don't forget to hit the thumbs up, don't forget to subscribe. It helps the small channel out so much. So let me know which company you guys want me to take a look at. I'm really kind of pumped to take a look at Norwegian to see how the COVID-19 is taking a look. But Wix and NortonLifeLock, I feel, have also some form of aspect that might have improved due to COVID-19. So Smile Direct Club right now reported earnings, and at the day it was down about 4.5%, and then after hours, after reporting earnings, this company was down another 2%. So right now it's sitting about 7.5%, and let's just take a look at this company in the past 6 months. So compared to the same date of February 20th, this company is actually down about 36% still from February 20th. And if you picked up at the bottom, you've actually gotten about 100% return already. So that's actually pretty crazy on how the stock market can return such amount of growth in such a little bit of time. So this company's earnings results are quarter one GAAP earnings per share were negative 28 cents, which actually missed by 8 cents. This company's revenue was 196 million, and that's up 10% compared to the same time last year, and it actually missed by 18 million. So first we can see just the size of this revenue. This company is making about $200 million when Cisco was making about $12 billion. And we can see this is a growth company. This is growing by double digits. This is going to be a growing companies, and with growing companies that have double digits, you usually see negative earnings per share, and that's because these companies are right now focusing on just collecting more customers so they can increase their revenue, and eventually their revenues will outpay their costs. So if you guys don't know Smile Direct Club, right, well, the main thing is they are like a tele-dentist where they provide aligner shipments to help out your teeth and straighten up your teeth. They're pretty much the braces, the Amazon of braces, if that's one way to take a look at them. And aligner shipments for this quarter were up 12% to 122,000 people. Average sales prices were also up by 2%. So we can see for the quarter, they were doing good. They were seeing an increase in price, and they were seeing an increase of shipments. But they do mention over the past 60 days, starting from May 13th, so that would be April 13th and March 13th. So that's pretty much when most of this started to happen. Kit and scan volume were down 40% during those 60 months due to the pandemic disruptions. So one thing you know right now, one thing we can see is, even though people are home right now, they really don't care about straightening their teeth as much. And that's actually, I was surprised. I would have expected more people to have actually picked up more kits right now while they were home, and will be able to just use them more often. So now let's take a look at this company's revenue growth. In 2019, this company's annual revenue growth grew about 77%. Again, that is a heavy growth. And in 2018, this company grew about 190%. So we can see this is a very strong growing company. And this quarter we saw a 10%, which was pretty weak. But again, we do have to remember it was impacted due to COVID-19. A lot of people probably right when working from home or due to the pandemic, they did not focus much about their teeth right now. And they had other things to worry about than going to Smile Direct Club's website. So now let's take a look at this company's presentation and what they showed during the earnings. First, let's take a look at gross margins. So gross margins for this quarter was 70%, and that was actually about 288 basis points decline compared to same time last year. In quarter one of 2019, this company had about 72.8 gross margin. Right now it has 70%. They do mention that a big portion of this gross margins decline was because here we can see in this graph, March 20th provided a very weak gross margins, and that's because a lot of the employees were sent home, and the facilities were closed during March, and but they were still paying their employees, so they saw a decrease in gross margins. They do say that the normalized would be February, and February they did provide a 74% gross margins, and they believe if this whole COVID-19 did not happen, February 20th would have been the normal, and that 74% would have been an increase compared to 72% compared same time last year. Additionally, this company is still focusing on their long-term target of achieving 85% of revenue gross margins, and that's actually pretty high. And one thing they are doing is they want to continue to focus on streamlining their manufacturing facilities, and they are on track to roll out a second generation automation machines by Q4 of this year, which will help out with the streamlining of manufacturing, and in the long term end up helping up that gross margin rate go up. And next, like I mentioned, right, companies like this are spending a lot of money on marketing and selling, and that's what they're trying to do and trying to achieve the most revenue. So first, right here, this chart shows us how much this marketing and selling expense has increased, and this is pretty much just what they pay on advertisement, what they spend on their salesperson, and just to be able to grab more customers. Right now, this company spent about $142 million in marketing and selling expense. And this is compared to same time last year, this company spent about $96 million. So that's a huge increase there that we saw in total increase of expense. And that's crazy, right? This company's total expense made up 72% of the total revenue. And that is why we see this company report negative earnings per share. 72% of your cost of compared to revenue comes from just this one expense. No wonder you're going to see negative earnings per share. They do mention that this expense, even though it has increased dramatically from same time last quarter, if we take a look at just the previous quarter of Q4 of 2019, the expense is pretty much on flatline growth. So it does seem like this company is no longer they believe they've achieved the right amount of marketing and expense, and now they're just gonna focus on increasing that revenue. They do mention if this company did not take that big hit in March and April, the total expense would have actually only been 66% of total net revenue compared to the 72% we see now. So we are seeing the expense flatten, and we're seeing the percentage of revenue compared to that expense go down, which is a really good sign. Next, they just wanted to the next few topics I wanted to talk about is this company says that their delinquency rate, so it's the amount of percentage of people that don't pay their bill, is pretty much flat compared to the rest of the years. And the main reason they say this is happening is because they have low monthly payments, and they also have the credit cards on file, so they're just pulling that money. And with the low monthly payment, they aren't seeing many customers request an extensions. They've only seen right now 1.7% of their customers request a payment deferral, and that's far below the 4 to 5% deferral request that other lenders are actually facing right now. So we can see, right, this company's revenue is still going to be coming in, or the payments are still going to be coming in, especially if they did not see much of a decline in these past few months. All right, so next we're going to take a look at this company's balance sheet. So this company right now, and this is compared to December 31st of 2019, so just 3 months ago. Cash 3 months ago was $318 million. Right now is $224 million. So they did see a big decrease in cash. And that's to be expected, or I would say that's to be expected, just because right now with the uncertainty of things, there was probably a portion, like we saw a portion where this company in March saw a decline in revenue, but still paid its employees. And that's probably a nice portion of this company's cash went. The next, and we're probably going to see a decrease in other liabilities as well later on. Total current assets were $590 million in December 31st. And right now it's $510 million, so a decrease of about $80 million. And again, most of that portion came from that cash and cash equivalents. And also, so again, nothing else there that really made a big difference in total current assets that I really want to take a look at. Next, let's take a look at this company's total assets. 3 months ago, this company had total assets of $885 million. Right now it has $847, a decrease of about $40 million compared to an $80 million drop in total current assets. But one thing to note is this company did report an extra asset this quarter that it did not report last quarter. And that's just because of accounting rules. Last quarter, they did not have to report it. Now they did. And that extra asset increased total assets by 43. So if we take off that total asset that was just added, and not compared same time last year, this company's total asset actually dropped by about 80 million, and that would be more to see more, and that was mainly due to the fact that total current assets dropped by about 80 million. But again, nothing here in total assets. This company still has a nice portion of total assets. No real red flags here are coming my way. Next, let's take a look at this company's total current liabilities. And total current liabilities right now is sitting at 217 million. And that's compared to 206 million just 3 months ago. And again, no real red flags there. The only thing I really want to mention about total current liabilities is about 10% of this company's total current liabilities comes from deferred revenue. And that's actually a pretty good thing. To me, deferred revenue is kind of a fake liability. Eventually, it ends up going into it ends up becoming cash. This company's long-term debt for this quarter is sitting at 183 million compared to 173 just 3 months ago. So this company did increase its long-term debt by about $10 million. But one good thing, this company has enough cash to actually pay off its long-term debt and to pay off its current portion of long-term debt. So current debt and long-term debt, this company will pretty much be at zero if it did that. But again, it shows me this company has a decent balance sheet. Total liabilities did increase by about 60 million. But again, this company also had an extra operating lease liability that it did not have last quarter, just like we saw in that asset. But unfortunately, we do see a decrease in total assets and we see an increase in total liabilities, and that to me is not a good thing. And even though this balance sheet is okay, it's not the best, and usually for growth companies you usually see a better balance sheet than this. So with this balance sheet, I'm not that happy about the company. So finally, let's take a look at this company's valuation. This is a growing company, so we're not seeing any positive earnings per share, so we don't want to take a look at a forward PE ratio for companies like this because there is no positive earnings. But one thing we do see is this company in 2021 is expected to make negative 30 cents, and in 2020 is expected negative 61. So there is a growth there, right? We're seeing that it's getting closer to at least breaking even company. Next, revenue estimates. In December 2020, this company is expected to make $883 million. In December 2021, this company is expected to make $1.17 billion. So that's actually over 20, maybe even close to 30% increase in revenue for the upcoming year. So we can see this is definitely a growth company. But unfortunately, this company does show to have a very low forward price to sales ratio. And the only reason I would think that this is happening is because this company, even at the end of the day, it still has a lot of expenses. So it's pretty much more of a retail type business where there is no type of subscription base. For example, in subscription based software companies, a forward price to sales ratio would usually be around 10. But right now we're seeing a company that has to create material, it has to pay for the material, and it has to all this. So we're seeing a forward price to sales ratio of below 1. Again, to me, this I'm actually a little confused. I would say it's maybe a bit undervalued. But again, actually no, let me think. We have a company that has an okay balance sheet. For a growth company, I want a very, very strong balance sheet. But here we're not getting this. We're seeing a company that has some decent amount of revenue growth, but it's not a very strong double digit. And finally, it is a company that after customers use it, there's no real point to keep repaying the customer. So there's no coming back. The only thing is more kids are being born and probably more people are having messed up teeth. So there are going to see more growth there. But to me, I'm not a fan of this company at the moment. And that's it for this episode, guys. I hope you guys enjoy it. Let me know what you think and take care, guys. Have a good night and see you next time.